19,500 is very difficult to sustain for the Nifty, and every time we are around that or slightly yesterday's high point was 19,520 or thereabout. We did not sustain that. Even Bank Nifty, it is racing down faster than the Nifty. Pull up the Bank Nifty, it will come up on your screen, 44,800 or thereabout. Anything above that, above 45,000, we actually getting knocked back. There is something about technicals, but mid cap and small cap are faring much better. This flip flop which you're talking about is restricted only to the main indices. Look at that. Okay, today mid caps are slightly on the weaker side. How should one be reading this kind of a market? Small caps made a fresh all-time high today, gaining 1%. Rohit Srivastava is here. Let's take our queries and questions and confusion to him, because he looks at charts and many other market indicators very closely and forms the bigger picture. Rohit, afternoon. Thanks for your time this afternoon on the show. Let's start by understanding the market pattern and in the Nifty's inability to sustain above the 19,500 and 45,000 on the Bank Nifty. Is it a sign of weakness? Should we not be compulsive Nifty, Bank Nifty traders right now and focus on stocks because there are no clear trends emerging and only look at a decline? What do you think?
Yeah, good afternoon. And my thoughts essentially are that we have seen a pretty good run-up, which makes it fair to expect some kind of consolidation before you start heading higher again. I don't think it's a trend reversal. It is only a short-term consolidation. Now, in that, what has been happening, which we have to be slightly aware of, is this market has moved with a lot of rotation, which means that at some points of time, you find certain sectors doing better than others or rotating. So you get outperformance in one sector, and then when that starts to pull back, you get outperformance in another sector. What that ends up doing is that the Nifty itself doesn't really give you serious pullbacks. You get a small 1-day dip, 2-day dip, and then it moves higher again. But the individual sectors you might see, or stocks you might actually see pullbacks that are slightly steeper individually. And I think that's a pattern that is likely to continue. So right now, if I just put out levels in case the Bank Nifty does dip more, I would think 44,500 is probably the worst case for Bank Nifty, and around 19,285 for the Nifty itself. Will it get there? Is again a question. But yeah, I will keep these open over the next 1 to 2 days in case there is selling in some stocks. But like I said, there can be rotation because there are other sectors that have already pulled back that can pick as well.
Before we talk about stocks, I just want to understand, you also look at slightly longer term Nifty. If we are to take, suppose, assuming next 1 month we don't go anywhere, we digest our gains made so far. How do the longer term charts look like? Say 6 months, 8 months, in the next 6 to 8 months, what does the chart tell you, the picture it may be emerging?
So it's a very good picture. I've been calling this a bull market since March of 2023, where we bottomed close to around 16,800. And the reason is that we completed an 18-month consolidation prior to that, within that range. And we called that the end of the consolidation, given that, a lot of stocks had already lost 70-80%. And sentiment, which is an important part of our Elliott wave analysis, had reached a negative extreme. If you look at things like the short positioning by FIIs or the very low put call ratios. Now, having said that, that's the starting point of what we are calling as a new phase or a continuation of the previous bull market, right? Which means that if you start from 2020, you ran up to 2021 October, you had a long 18-month consolidation, and what you started now is a completely fresh phase of moving higher from here to new highs, which could probably continue for the rest of this year. So then that takes us to, okay, what levels can that really mean? See, we've broken past a trend line of all the tops. So if you join the 18,600 top of October and then the 18,800, 887 top of December 2022, that line comes in at 19,040. So now that is the major support for this bull run case from where we head higher. And initially, we should probably see that we get past 20,000 at some point of time. Markets will consolidate a little longer. I don't think we are there yet. This still looks like a smaller pullback, what we are seeing in the short term. We will get a little more prolonged consolidation, I think, once we get closer to 19,800, 900 or thereabouts. But the overall trend, say, even if you get that kind of a consolidation, which means 3 to 5 weeks of range-bound markets, a lot of up-down swings. Eventually, my sense is we break out higher because, like I said, we are calling this the start of a new bullish phase where you're seeing participation from almost every sector, including mid and small caps, which is why your breadth is very, very strong. So that I think will continue for a period of time. So for investors, it's a very good phase. Traders have to only stay alert of those near-term moves, but at the same time, what we also would like to say is that what is happening, because I find once in a while I find people calling up and saying, "Oh, we have shorted the market." Now, in a rising market, you typically don't want to short. You want to be on the side of the bull, which means you generally say you do a long exit kind of strategy. So booking gains on the long side is fine. You get a pullback, you can add again, but you should not be the short side when the larger trend is up. That is a basic trading guideline for anybody.
Right, Rohit. I just want to ask on just a couple of specific stocks. And firstly, let's just talk about in terms of what would you be talking about in terms of the defense names? Like today, when you see an HAL, a Mascow Dock, that run-up is already done. Do you think and do you expect a correction here, or how should we be viewing the defense stocks now?
Yes, so while I'll not make specific stock comments because we don't really give investment advice, but I can tell you that out of all these sectors, one of the approaches for us in terms of choosing what stocks we should invest in or sectors we should chase is looking for outperformance. So outperformance means that if a particular sector stock is holding above, say, the 50-week average, throughout the last year, then it's a sign of strength where you haven't seen significant pullbacks. And the defense sector would essentially come in that. Most of the defense stocks, even the ones you mentioned and the others which are there, I think mostly have not really broken, the 50-week average over the last 2 years. And so it's been a pretty strong sector. And while you may feel at times that, okay, it has run up a lot and should there be a pullback, the pullbacks will essentially be consolidations or retracements inside a larger uptrend. So pullbacks are good. They give you opportunities to, enter at higher levels. But it doesn't really, make us change our view that the larger trend for the sector will continue to be bullish.
How would you approach IT? Top 5 names, just for illustration purpose. I completely understand your stance, but Infi, TCS, HCL Tech, L&T Mindtree, the large ones which are F&O liquid names, or maybe some mid-cap ones as well, like Persistent. How would you approach IT right now?
So we try to run some kind of a filter. We have a new software to help us, scan heat maps of, how stocks or sectors are doing within a sector, how different stocks are doing. And you will actually find that the outperformers within IT are, smaller names. Again, not a recommendation, but say, for example, something like a Sonata Software. Now, that is outperforming the basket, or you'll come across a Datamatics, which is outperforming the basket. But when you'll go and look at large caps like Infosys or HCL Tech, or specifically maybe Wipro, they are not really doing that well. So clearly, there is a division between what we call as large cap IT and mid cap IT. So within the IT space, you make that bifurcation. We would sense that large cap IT is likely to do less well than the mid cap IT. That is sort of what the performance is also showing so far. And it goes back to the pattern that was there pre-COVID. So there was this, beautiful period post-COVID where all IT stocks did exceedingly well. But if you look at the 2010 to 2018 period, it was again led more by mid-cap IT stocks outperforming large-cap IT. I think that is probably appearing to have come back in terms of pattern.
Pharma, on the one hand, stocks like Sun Pharma almost getting back to 1100. Biocon has come back in style, one of the big underperformers. Lupin also kind of multi-year corrective phase is getting, but not only that, mid-cap, the forgotten ones like Marksons and all of these. How are you approaching the pharma pack?
Yeah, so like I mentioned, that March was a very important period to end the negative trend, and I think pharma probably fell for a while longer. But I think by May, most of the pharma stocks are showing signs that they've bottomed out. But I just have a caveat there are two types of people: those I love pharma and want to own pharma. So surely, if we say that pharma stocks have bottomed out, they're likely to do well. But on the other hand, will they really be the best performers of this phase? So when it comes to looking at the defensive sectors, which is pharma and FMCG, in fact, I even take large cap IT as a defensive sector. They tend to have these cycles where for 8-10 years they do exceedingly well, and then 8-10 years they don't do that well. At least this is what we've seen for the last 3 decades. So we can actually look at the 1990s, and you take the 2000s, and then you take the 2010s. So in the 1990s, defensive did exceedingly well, beat everything else, but you had cyclicals, performing poorly, long consolidation phase for 7-8 years. And then you had cyclicals and, hardcore economic sector stocks doing very well, and the defensives really underperforming in a big way. The same pattern again shifted back towards, defensive in the 2010s. And now I think 2020 to 2030 is a phase where I would want to generally not own too much of defensive, because they will tend to give you lesser returns than the growth sectors. And that is where a pharma comes. So they have bottomed, they will probably rise from here. But if I have the option of owning a defense stock or a capital goods stock versus a pharma stock, I will definitely prefer the first two versus pharma. So that is the allocation that I would end up doing.
Okay, and I just want to understand one thing, Rohit. Also, in terms of the capital goods space, that has been doing the rounds in terms of a lot of companies over there as well. What is your view on the capital goods space?
So it's been a no-brainer, because I think if you just go back to the budget moment they announced that the government's going to support that 30% additional capex, whatever thoughts we had, we would have really hoped, wave perspective, what we look for is, well, after something has gone up in 5 waves, you look for a 3-wave retracement. So I'm being a little technical here. And we would have then thought that, well, the capital goods sector, just like metals and all, should give you a 38-50% retracement of those gains. But I think these steps taken thought that the retracement was very, very small. The stocks in the sector, the likes of maybe L&T or even ABB and so on, had very small retracements, consolidations, and then they started to trend higher again. And that, I think, is what is playing out now. So when you have support of that kind in terms of spending and orders coming through for a sector just like defense, I think these two have that advantage that the visibility is there. So then I think it's a sector where you're just trending higher. You just want to only for fresh entries you look for, okay, will it pull back? Will you get some kind of a retracement back to the averages where you can get a better price? But apart from that, you just want to hold on and ride these moves for the next year or two.
Right, Rohit, thank you so much for joining in with us this afternoon on Markets at Noon and giving us an understanding on the markets. Where should we see headed as well.